Sylvia's Traders Lounge welcomes you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology.
Today's guest is Freddricks Scott, and our theme is metrics of picking the right stocks for your trading and investments.
Hello guys, thank you all for tuning in to today's webinar. Today's guest is Fred Scott.
Hi, nice to meet everybody.
Scott's bio. Fred Scott was a portfolio manager for a small hedge fund from July 2009 to August 2015. His specialty is picking stocks that can sustain a multi-year growth path and disrupt their respective industries. Scott utilizes both long and short strategies, but always approaches the markets from a fundamental point of view. His investment journey started in high school. Scott had an economics teacher that believed stocks were the only way to make real money. He pressed upon him the urgency to learn how to invest in stocks early on. This same teacher believed the days of working for 30 years and retiring with a comfortable pension were over. He was ahead of his time. Pensions were still very popular retirement vehicles back then. Fast forward to present day, it is very hard to find jobs that offer a decent pension anymore. After trading stocks with his own money for a few years, Scott was approached by a friend who was interested in starting a hedge fund. This new partnership allowed him to utilize his own trading strategies on a larger scale and fine-tune his investment techniques. Scott was very lucky to have people that believed in him and had so much trust in someone as young as he was. Following his professional career trading, Scott continues to invest and grow his own portfolio. He continued to use similar strategies with the added benefit of not having to show his investors his profit and loss statement every quarter. Scott feels this is where retail investors have the edge over professionals in that he just does not have to kill himself, kill in quotes, to make a basis point a week before the quarter is over. This allows him freedom to take his time and wait for the perfect pitch. So thank you for making the time, Scott. I know it's very early in your state. Yeah. And maybe you can start off by telling us about how your trading and investment journey started, becoming an independent fund manager for close to a decade, and what has kept you grounded while you're trading and investing in US equities.
The way that I started was basically through curiosity only. Like I thought it was just something interesting to do, and nobody told me about it. I just found it going through library books and things like that. I started reading a book about the dollar, and it described how the dollar was created and how it worked, and most of the story that people don't realize about the dollar. And I got interested in that particular aspect. I was like, oh well, if the dollar is such an intricate thing, then I wonder how the financial system really works, because the way that we think of reserve banking and things like that is not the way that bankers think of it. So I wanted to see, like, I thought that by understanding where money goes, where it comes and where it goes to, by understanding how money flows through the system, you kind of get a pretty good understanding on equal geopolitics, things like elections, like we just had one here. I'm not saying that everything is bought and paid for, but you at least can see what are the probabilities that could happen by looking at how money flows. So from there, I got interested in stocks, reading a book by this gentleman, Peter Lynch. He wrote a book called Beating the Street, I believe it's called. You guys can look it up. It's pretty good. For any beginner trader, I always recommend Peter Lynch. And he kind of put stocks in such a simple way that it was really easy for me to get it. He basically just said, buy the companies that you know. You know, some people have an iPhone. It's just as simple as going to buy Apple stock. And if you did something as simple as that, you did very well for yourself. Better than most people could do managing professional money for decades. Just buying a share in Apple, leaving it alone, you would have done much better than any of those people. So it's simple things like that looking at what's around us, looking at how it impacts us. And also, I saw other investors doing the same thing. Like Warren Buffett used to count the caps of Coca-Cola bottles in the gas stations. And he used to say like, oh, okay, well, people are drinking more of this soda than the other sodas. So he just went about Coke stock. It's really that simple. And, he is Warren Buffett today. So it obviously worked out for him. And for the way that I stayed basically interested in this is because I'm a curious person by nature. And the markets change every single day. And we might think we know something, and then the market shows us that we probably didn't. So that fascinates me. And I always want to learn and improve.
All right, Scott. So given your experience and moving to, running a hedge fund, how can you define the difference between trading and investing in stocks? Yeah.
Trading is mostly, I look at it as a philosophical thing, meaning like trading, I make trades today too, and there are investments. Like if I see that in a particular quarter, like for example, I'll give you guys a quick one. With this pandemic, it's pretty simple to understand that people are buying a lot of everything. So if you look around and you're like, well, what are the only stores open? Walmart, Target, things like that. Why not invest in that? And if you did, you would have made, I don't know, 40% or so in a quick 4 or 5 month basis. Now, I'm not interested in owning Target for a long-term thing, but I think for a trade, it was the right thing to do at the right time. So for me, it's more about conviction and how you feel about your investment or your trade. But I would never turn a trade into an investment. If I buy a stock for just a trade, for example, if my thesis was people are buying a lot of stuff, buying stock in Target would be simple because everyone goes there. So if my thesis was that, and I'm proven wrong, let's say Target reports and it's a disaster, the number doesn't work out, nobody went to Target, I had to exit it at that minute because it didn't do what I thought it would do. So that's the difference between investments and trades for me. A trade is something that I have a specific thesis and I go from there. And an investment is a whole different thing. Like I develop a whole criteria of reasons why I want to get into an investment, why I want to get out of it. Um, I look at it from a multi-year point of view. Like investments for me are usually based on themes. For example, now we are moving more towards software, like with the Zoom thing. So it's changing the way that workplaces are doing business. Like big deals are getting done even now that we're not seeing each other face to face. People are going on Zoom, like meetings like this, and they're making multi-billion-dollar deals, no problem. And nobody would have thought that was possible 10 months ago. So that has proven to be a long-lasting theme that I can invest in. It's cloud stocks, things like that. So that would be the difference from a philosophical point of view of an investment and a trade.
All right. And so when you're using that criteria to trade in stocks, what metrics do you look for when picking the right stocks? Maybe you can define to us, maybe using a recent example of the kind of stock that you're looking into. And then how do you identify the time horizon for investing in stocks that fit your investment model?
Time horizon goes to the thing we just talked about, depending if it's a trade or an investment. If it's a trade, then the time horizon would be an event, usually. So if I'm trading on the target's next earnings results and I'm betting that they're going to be good, then that's my time frame. That's my time horizon. And if it works out my way, I exit it. Even though the stock might go up without me, I fulfill the what do you call it? The elements that I set for myself. So if I don't really worry about the price of the stock, what happens after I sell it. I just think, is it going to do what I needed to do at that point? So that's kind of determining time horizon. If it's an investment, if it's something like, again, Apple, for example, I'm not an investor in Apple, by the way, but just as an example, if you think iPhones are going to be here to stay, and every year iPhone sales are stable climb out, maybe they climb out by 2-3%, which is pretty good for a company that size, then you keep it for as long as that continues. So if Apple continues to sell iPhones every single year, 3, 4, 5% per year, you have no reason to sell that stock. So basically, time horizon and reason for buying your stock are hand in hand. And if you don't understand why you're buying a stock, then your time horizon will be screwed up too. Exiting, like I just said, it depends on your plan in the beginning. So if you know that Apple's going to sell, if it's going to grow iPhone sales 5% every year, you hold that stock until that stops. The mistake a lot of people make is they change their metrics onto something else. So if my metric, for example, here is iPhone sales, that should be the only thing I should be worried about. I shouldn't really care about anything else, just cash flow from operations. Now, when it comes, you were asking about metrics, so I guess this ties into it. I prefer cash flow because it's one thing that is really hard to mess around with accounting wise. Like equity is really simple to screw with. For example, if you own a company and you hire 10 people, that comes out of your cash flow of operations. It goes into your equity, right? So you're taking away from your equity. So if at the end of the quarter, you're supposed to earn $1 in earnings, after you pay all your workers, you only have 20 cents in earnings. What a lot of companies do is they just fire a bunch of people and it makes the equity number go up. So it artificially inflates the earnings per share. And a lot of, there's nothing illegal about it. There's nothing weird about it. It's just the way business is done. So there are numbers that you can manipulate in accounting. Earnings is definitely one of them. Cash flow from operations could be manipulated, but it's much more difficult to do because you can see what money goes in, what money goes out through the income statement. So in my opinion, the most important metric is cash flow. And a company can have whatever earnings they want, but if they're not selling anything, there's no cash flow. So that would have prevented people from getting screwed with something like Enron or something like General Electric or something like that. Like you would have seen that coming if you would have been paying attention to the cash flow because there was no cash being generated. But for some reason, the earnings kept going up every quarter. So that kind of leaves you wondering, like, why is this happening? Investors didn't care because they just saw the earnings per share go up every quarter. But if you paid a little bit more attention, you would have seen that the cash flow was going down every single quarter. And that would have been like a good tale. It doesn't always work, but it will keep you out of trouble for a long time.
Yeah, that makes sense. Cash flow. I think cash is king in so many ways. And what comprises a good stock portfolio for your long term and also for your short term trading while you're trading stocks?
I look at it as do you mean for a personal basis or professional basis?
For your professional trading? Yeah.
Well, because I would give a different answer for each one. So
Okay.
professionally, the stock portfolio that you have should be dependent on how much research you can do. So if you can do research on 20 companies, then that's what you should have. If you can do research on 1,000 companies, like Peter Lynch used to do, then that's what you used to have. That's what he should have. So there's no right or wrong when it comes to a number. There's people like Bill Ackman that only have 10, 12 stocks because that's the research that he put into those 10 to 12 stocks. So it doesn't really matter the number that you have, just how much of a research arm do you put behind it. And when it comes to personal, I don't like to separate investments from the rest of your life. So if you have any kind of credit card debt or anything like that, I would include that with your overall portfolio. And the more debt you have, the less of a performance your portfolio is going to have. So you have to figure out a way to like bring down your debt, and then you can focus more on investing. But let's say you don't have any debt and you want to invest in stocks, then you can do the same thing. Get as many stocks as you can research. So if you can only research 4 or 5, only get 4 or 5. I don't agree the diversification has to be done, because today in the global world, you're already kind of diversified. For example, if you buy a stock in Apple, just to go to the same thing, they do business in China, here, anywhere in the world. They are diversified through currency. They are diversified through sales channels. They have different business lines. They just don't sell iPhones anymore. They do all these services stuff. So you're already diversified just owning one stock. So if the market in the United States were to go down, but the Chinese market's doing well and people are buying iPhones, kind of like it's going on right now, that's why Apple stock continues to go up. So even though America might not be doing so good, they're still selling a lot of iPhones in China. So you're already diversified just owning one stock. So just knowing what company you want and really understanding how they make money, how their businesses are operated, where they're operated, all that matters. And if you buy a company that's purely domestic, which are really hard to find these days, then you might want to diversify. But for the most part, every company does business all around the world. So if you stay in the large cap space, you will be diversified no matter what company you pick. And if the market goes down, everything will go down. So you wouldn't be worried about it because you would be in trouble just like everyone else would be. But I don't think that you should diversify just for this diversification sake. You know what I mean? So if you have, like, let's say you buy a stock in a bank that only does business in your city, then yeah, you should definitely diversify to another place. But if you're buying stock in JP Morgan that has operations all over the world, you shouldn't be worried about that too much. This is what I think.
All right, so maybe now you can take us through your approach towards trading, and then we go through your presentation, and then we'll get to the Q&A right after that.
Okay, so you want me to do the presentation now?
Yeah, you can share your screen, and
Okay.
then, yeah, basically your practical approach towards your trading and investments in stocks.
All right. Can you guys see that?
Yeah.
All right. So I'm calling my presentation value investing because value could be basically determined from all kinds of views. Now, people like to think of value as cheap stocks versus expensive stocks, which would be growth. But a lot of people would disagree with that, and I'm one of those people who disagrees. Value, all it means is basically what are investors willing to pay for something, and can you find someone else that's willing to pay more for that same thing? I'm paraphrasing what's on the screen, but you guys could see it. So what that means is value could be basically found anywhere. If you find a bottle cap on the floor and you determine that bottle cap is worth $1, nobody could tell you you're wrong. Only the market can. So if you go outside and you try to sell it and people would only give you 50 cents for it, then the value of your bottle cap went down by 50%, but there's still value there. It's just not the value that you thought it was. So that's how I like to look at it when it comes to value versus growth. It doesn't really matter if it's a business that's growing, if it's a business that's not growing. It doesn't matter if it's an expensive company or a cheap company. What matters is what you think it's worth and what the market thinks it's worth. And the differential between the two, that's where your profit or your loss will be. Now, intrinsic value is basically the meaning or the essence of what value is. So, for example, going back to the same example, the bottle cap, you thought it had an intrinsic value of $1, but the market says it's 50 cents. Now, you might think the market's wrong. And here I might lose some people who believe that markets are always efficient. And a value investor never believes markets are efficient. If they did, they would be out of work. So what you basically want, if you're a person who values stocks for a living, or if you follow anybody like Warren Buffett, Peter Lynch, or any of those people like that, none of them believe the market's efficient, because if the markets were efficient, there wouldn't be such thing as cheap or expensive stocks. Every stock would be worth what it's supposed to be worth, and that's that. So since the market makes mistakes, as we know, we've seen market crashes, we've seen moves for no reason, we've seen flash crashes where computers go haywire, all kinds of things. All those things are inefficiencies in the system. So intrinsic value means we had to find out how much is this particular asset really worth? What is its intrinsic value? So if we find a bottle cap and we know that bottle cap is worth $1, but the market only gives us 50 cents for it, now are we wrong? Or is the market just not caught on to the idea that it's really worth $1 yet? Now, a value investor would say, the market's wrong. I'm just going to sit on this bottle cap until somebody's willing to give me $1.10 for it. That's what a value investor would do. A guy who just follows charts would just be like, well, obviously it didn't work out. You broke the resistance. I'm out. A guy who is a growth investor says, well, this bottle cap is not going to earn any more income, so I'm just going to get out of this. So this would determine what kind of investor you're going to be or trader. This could be applied for either one. So if intrinsic value is whatever you think it is, which is after you do all the work, let's say you take, I'm gonna bring an example that's a little more relatable. So if we have a business like Apple, it's just really easy to value something like that. You can know what the intrinsic value of Apple is simply by looking at their cash flow, taking out all their debts, taking out all their costs, whatever's left, that's the intrinsic value. It's pretty much that simple. Now, there's other companies that are more complicated, like banks. It's pretty hard to figure out what intrinsic value of a bank is, but there are people who are very good at determining that kind of thing. That's not my expertise. I apologize. But banks basically have assets and liabilities. And if you really want to quickly know what intrinsic value for a bank is, just look at the book value. It would show you the same kind of thing, at least in a ballpark. So if you go to any financial website, Yahoo Finance or anything like that, and you look up any bank, let's say you're interested in investing in JP Morgan, you can see on the metrics that it says book value. So that would give you a rough idea what the bank would be worth if they closed down the doors today and they liquidated everything. That's what the bank would be worth. So intrinsic value and book value are both the same thing. Now here, quantifying intrinsic value, it basically goes to what I was just telling you guys. So how do you find out what intrinsic value is? And that this set of steps sort of show you, okay, well, this is the cash, this is the debt, this is the equity, whatever way you want to go about it, it's fine. A lot of people like to do discount cash flow models, DCFs for short, and that's perfectly fine. And one thing that I hope you guys see for now, it's that there's no set structure for how to do this. Every investor is going to have their way, which is why value investing is more of an art, less of a science. There's no exact meaning of what intrinsic value is. There's only an estimation of what it is. And the estimation is made by you, the investor. So you can either decide if the market is wrong or if you're wrong. There's ways of testing that theory, but that would be another talk for another day. Mm-hmm. Marginal safety is basically the way that you can protect yourself from mistakes that you don't see coming. For example, going back to Apple. So if you know that after Apple liquidates everything and they close down shop, they say, okay, we can't keep making phones anymore, we're done. If you know that after they do all of that, they pay all their debts, everything, the company's worth, let's say $1 trillion, which is fair. If the company's worth $1 trillion after everything is liquidated, and the market is only valuing it for $600 billion, there's a difference of $400 billion there. That would be something that you would consider as the margin of safety. Because if you're wrong, then your intrinsic value is off by 400 million. If you're right, then you're gonna earn an expected return of $400 billion in that specific example. So which would be like 40% or so. So your expected return is basically tied somewhat to your margin of safety. Not always, but that could be a good starting point for you to understand how much money do I expect to make from this. So if you want to buy a stock for $100, let's say it's Nike. I don't know how much it's trading for right now, but I think it's above that. So let's say it's Nike, and you think the intrinsic value is $100, and the stock is right now trading at 60. Well, your expected return is 40%, because from 60 to 100, it's 40%. Now, are you gonna sell after that? That's up to you. If you want, that would be a pretty good exit point. But if you don't, and if you think the company is fine, and if you think that they still have more growth ahead of them, then you have to do another discounted cash flow analysis to figure out how much is worth now, because maybe you didn't account for something. Maybe the growth rate expanded. Maybe it's growing faster than you thought. Maybe you were projecting growth of 15% for 5 years, but it turns out it was growth of 25% for 5 years. So you have to tweak your numbers as you go. First you project, then you tweak your numbers as they go. So margin of safety is how much room do you give yourself for failure? So if you thought the Nike stock that was worth $100, let's say you thought it was worth $100, and the stock went down to $40, but you bought it at 60, you only lost 20%, which is a lot, but it prevented you from losing even more if you would have bought it at a higher price. So determining your margin of safety is pretty important if you're not sure of your level of certainty. And I like to tie it to that, because if I'm very sure about an investment, I might have a smaller margin of safety. For example, if I want to buy a stock for $100 a share, and I'm so positive that it's gonna go past that, and the stock is currently trading at 80, I don't mind having a margin of safety of 20% or $20 or so. I don't mind having that because I have a higher conviction on this particular investment. Now, it also is tied to your risk tolerance. If you're not really risk averse, then you can withstand an even more narrow margin of safety. Like a lot of people would buy a stock that is fully valued. A lot of people were questioning Warren Buffett when he bought shares in Apple a year ago or so. People thought that he lost his way because Apple was a fairly valued company and nobody thought it was cheap. So people were saying, is he losing it? What's wrong with him? Well, turns out it was one of his best trades ever. And he took a very small margin of safety in that one. So it could work in your benefit. You just have to be aware of your exit strategy and the unknowns. If the more unknowable things you have, the larger margin of safety I suggest you have. But again, this is more of a art, less of a science. So it's really up to each person's aptitude. Now, this is what I was telling you guys before with EMT. If you believe that the markets are perfectly efficient, then I have nothing to tell you. But if you think that they make mistakes, like I do, and like a lot of people do, then value investors are basically the people that clean up after those mistakes. So in 2008, to show you guys a good example, the housing crisis happened here in America. A lot of people lost everything. Banks went down a lot. Some went out of business. Lehman Brothers, things like that. Bear Stearns. Some banks were forced to be acquired by other bigger banks. It was a mess. So if you're a value investor, that's heaven for you, because things are trading so crazily that nobody really knows what the intrinsic value is. People just want to get out of the trade. They don't really care what it cost them. That was 2008. People just wanted out. So a person like Buffett, which is exactly what he did, is he went in there and he started buying banks. He bought a big stake in Bank of America. He made a lot of money from that, and he bought it for a very cheap price, and he basically saved the bank. So in a way, he did a good thing, and he also was paid handsomely for it. So you want the market to be inefficient if you're a value investor. which is why most value investors don't trade a lot, because the market doesn't make mistakes often. But when it does, you get a pounce. So a lot of value investors have 20, 30, 40% in cash a lot of the time. Like I think Warren Buffett has like 150, 160 billion just in cash. Just whenever something happens, he can just jump on it. He doesn't have to wait for it. So that kind of thing is something you have to take in account if you want to be a value investor. Is you might not want to be fully invested. You might want to be invested. If the market is highly overvalued and you think things are too high, then I say, 80, 90% invested. But if the market, I'm sorry, 60 to 70% invested. But if the market is undervalued, then you want to be all in as much as you possibly can. Because if you think that, like in 2008, when stocks were going down for no reason, some for good reason, but some for not good reasons. Like I think Amazon went down to like $9 a share. So imagine if you would have bought Amazon at $9 a share right now, you would do it pretty well. So and what did Amazon have to do with the housing crisis? Nothing. So that shows you that the market makes mistakes and you got to take advantage of them as they come. This is something that I'm sure you guys are used to hearing from a lot of traders. Your emotions are your worst enemy per se, but they also can be useful. For example, because conviction is an emotion. So I'm not gonna lie to you and tell you that traders are emotionless robots. I don't believe that. Some of the best traders trade on pure instinct, and instinct is an emotion. So they can be hypocritical and tell you not to do the same thing. So what I say is extreme emotions are bad. So if you're holding a stock and your stock goes down by 50% and you start feeling awful and you can't sleep, honestly, you're probably better off selling it, because the pain that it's causing you is so much more than the financial gain you could possibly gain from it. So if that kind of thing hurts you, then you know what your weakness is. And I think the most important thing about emotions is knowing what your weaknesses are. So if you know that you have a low threshold for pain, like if you can only take a 5% loss, then cut your trades off at 5%. If you can only take a 20% loss, cut it at 20%. The reason why I say this is because if you ignore those feelings, you're going to sell down 50%. You could have sold at 20%, but you sold it down 50. So, and a lot of people make this mistake. I've seen it. Even pros make that mistake. It's natural. So don't feel bad if it happens to you. But just know that emotions, when it comes to setting up your plan, they don't go together. But if you know that you're an emotional type, I'm not saying trading and investing is not for you. What I would recommend is plan better. So if you know you're an emotional person, give yourself a larger margin of safety. If you want to buy stock and you think it's worth $100 and it's trading at 80, wait till it goes down to 60 and then buy it there. So give yourself a larger cushion. So that way, if you lose money, you won't feel that bad. That's why it's important to know your emotions, how you handle things, and look at your personal lives first and how you handle bad news. From there, you can actually get a pretty good gauge on how you're going to handle losing money, because there's nothing more emotional other than family. It's money. So this is a real world example of inefficiencies. So this is a company that I believe was acquired by Google, Fitbit, and they reported a spectacular quarter. For some reason, the stock went down a lot. If you were a value investor, you would have seen the quarter and you would have been like, what's wrong with this company? They must know something I don't, right? A lot of us would freeze and not do anything. But if you did the work and you understood the numbers, then you could be like, there's nothing wrong with this company. It's just the market acting crazy. You would have bought and you would have made a pretty substantial gain. This happens every single quarter. This is just one example out of thousands. So, actually, I believe it happened 2 weeks ago with Microsoft. They reported a very good quarter, a record-breaking quarter, and the stock went down by like 15, 20%. which is ridiculous. Why would it do that? So that shows you right there. It's like, well, the market is missing something, or maybe just people who made a lot of money in the stock just want it out. It could be many reasons. So if you're the type of person that knows that this stock is not worth, it shouldn't be down, and it's worth more than it is today, then you should have no reason to step in and buy it, which is why it's good to have cash on the side, because these kinds of things happen more often than not. Now, here's kind of what Sylvia was alluding to earlier. How do I go about choosing a stock? And that I like to go with things that I know. And people always tell you, invest in the things you know, stay away from the things you don't know. If you don't know a lot, then you got a problem. But if you know a little bit about, like, let's say a computer, you use your computer, you're turning it on. Where did the computer come from? A company called HP, Lenovo, whatever. Look into that company. It might not be worth looking into it afterwards, but it would be a good exercise. So look at your phone. What kind of phone do you have? If you have an iPhone, then you know Apple made it. If you have a Huawei or whatever, like, it's hard to invest in that from here, but I think for you guys it's different. So there's things that you can do looking around your neighborhood. Like, I think one of my best trades basically was a friend who bought a Roku way back in the day. This is like before people even knew what Roku was. And he had the little box, and in it was, Netflix and Hulu and all these other streaming services when they were barely beginning. This was maybe 9 years ago, 8 years ago. And Roku was nothing. And I remember seeing this box and I'm like, I wonder what this is. And then when it became a public company, I bought a share or two because I knew it was pretty good item. It was a good product and it did what it was supposed to do. There's no risk because Roku's not producing movies. They're just putting them in the device for you. So I was like, this is like a credit card company. I thought, well, like a payment processing company, like Visa. Visa doesn't lose money in credit because they don't give credit to anyone. All they do is take a little bite of every time you swipe your card. So Roku to me was that. It was like they took a little chunk of every time you went to stream Netflix or whatever. So that was one of the, I think it's gone up like, I don't know, 500, 600%, something like that. So ideas like that are easier to come by than you guys think. And, pay attention to your friends, pay attention to what's around you. You can get inspired by all kinds of things. And sometimes even things that you might not think you can make money on, you can. Like your utilities. Like you pay your light bill every month. Why not invest in that utility? They pay a dividend. So if you are paying your light bill every month, get some money back. That's the way that I see it. And this is how I usually try to go about it. I like to, like I said before, I like to look at cash flows. That's the most important thing for me. I look at sales because that's where the cash comes from. And I look at expenses and debt, and because that's usually where the cash goes. So I just follow the cash coming in, the cash going out. Pretty simple to see that. In American companies, at least, you can find all this information in the SEC website or in each company's website in investor relations links. Pretty easy to find. International companies is a little different because accounting standards are different. So what here would be considered an expense in China, for example, I've seen companies there that don't even count wages as expenses. They count them as like operating income, which is kind of crazy, but they do. So you have to be aware of what accounting standards are in the companies that you're looking at. And America's not the best when it comes to accounting standards. There's a lot of games accountants play with this. Like they have GAAP earnings, which will be GAAP, which will stand for General Accepted Accounting Principles. That is the most accurate measure of accounting. And they have non-GAAP earnings, which would be like all these weird terms that companies come up with. Like recently, I don't know if you guys heard of WeWork. They came up with something called like community EBITDA, which is they just made that up. So that was a pretty good sign for you to just not invest in that. And that company ended up being almost bankrupt. I think they got saved by SoftBank. But yeah, like that kind of thing happens. And sometimes when you see something that's so goofy as community EBITDA, then that should be a red flag. So just pay attention to those things. And yeah, just follow the cash in, cash out, make sure you know where it goes. And if you see a lot of goodwill, this is something I didn't include in my presentation, but I'll tell you guys. Goodwill expenses is basically when a company acquires another, they write it off as goodwill. I don't know why they call it goodwill, but that's what they call it. If you see a lot of money going in there for some reason, then you know the company's spending either too much money acquiring smaller companies, because they don't announce every acquisition they make. So they could be just buying tiny companies. And companies like Google, Facebook, they do this a lot. They buy tiny companies nobody knows of just for one particular feature. So look at that. And if that is getting bigger every quarter, you might want to ask questions to see what's going on, because that will let you know there's some irregularity happening. It's not always the case. It's just if that number keeps going up, that means the earnings per share are going up as well, because it's all connected. So if earnings are going up as well and the investors are happy and the stock is going up, those might not be legit earnings. They might just stop one day because the company stopped buying other companies. So they call those roll-ups. And those companies are like, conglomerates like GE and things like that. GE is much smaller now, but it used to be the biggest one at this kind of thing. They used to just have enormous goodwill expenses and nobody knew why. And the earnings per share would go up every week. And reading a financial statement from GE back in the day was nearly impossible. Like almost nobody could do it. It was just so complicated. So stay away from companies with that kind of nebulous financial statements. And yeah, just to wrap it all up, basically determine your investment horizon, which is, are you doing this for a trade? Are you doing this for an investment? If you're doing it for a trade, make sure you know what the trigger is. So if it's going to be an earnings report, that's the trigger. If it's going to be a product that's coming out, that's the trigger. Whatever it is, identify that. Once it happens, get out of it. If it's an investment and you project that the company is going to grow 10% every year, keep it as long as that holds. If that falls, you got to investigate why. And if it's a reason that you don't like, get out of it too. Investments are not, you don't have to hold it forever. It's just something that you hold for a longer period of time than usual. As long as the company does what you think it's going to do, stay in it. There's no reason to sell it. Now, after that, determining your margin of safety, how much are you willing to accept loss, handle your emotions, and determine where cash comes, where cash goes. And that's basically it.
Thank you so much, Scott, for that presentation. Sorry, guys, about the noise.
That's okay.
And yeah, so now I welcome my co-host to take the Q&A from the webinar participants. Dennis.
Thank you, Sylvia. Several questions coming in. One of the questions that a member of the audience is asking, Christopher, is about your personal trading experience, basically, and he wants to know what your worst traded stock was and what influenced, that loss. Or rather, what didn't you see before trading that stock, basically?
Wait, can you repeat that one more time? There's a big delay when you talk.
Okay. So Christopher wants to know what your worst traded stock was and what influenced your loss. Or rather, what didn't you see before trading that stock? Probably in your analysis or something.
The last loss?
Yeah.
Yeah, I think it's, I didn't per se lose, but I lost the opportunity, which was probably worse because sometimes it sucks to see something, not act on it, and then it just slides right through your hands. For me, it was Tesla. I kind of saw it when it was about $140 a share before the stock split. And I thought, well, everybody in California, at least where I live, everybody drives Teslas. They're everywhere. And I'm like, this is going to be something huge because in California, it's a driving culture and everybody here has a car. And if you don't have one, you're kind of in trouble. So I'm like, well, if people love Tesla so much here, because usually the car market begins in California and then it extends to the rest of the world. I don't know why, but they test every car here. There's all these tracks, whatever. So I saw that, and then I started reading on the company, and Elon Musk kind of threw me off because he's kind of like a different type of guy, as you guys might know. And he says things that are not always true. And the projections he was making were making me kind of like, is this guy a con artist? Is he for real? I couldn't tell. So I said I pass on it because I couldn't figure that guy out. And the company runs on that guy. If he's not in the company, I don't know what the company would do. Honestly, it's all him. So I knew that, and I knew the car was a good car. I have a friend who has one. It's one of the best cars I've ever seen. But the company had a lot of questions back in the day. Some people thought it was going to go bankrupt. There was a lot of debt. They couldn't service it. All kinds of things were happening at that point. Well, fast forward 1 year after, and now Elon Musk is like the third richest person in the world, I think. And the company is like bigger than the market cap of GE and all these Exxon Mobil and all these, like Tesla is a gigantic company now. So I would have made an insane amount of money if I would have bought that stock. And that kind of hurts me more than losing money.
Okay. For the last decade, the stock market has basically been booming thanks to the speculative fervor that has been out there and the fact that the Fed has been pumping a lot of money in the system. Do you think value investing has been dead so far?
What's the last word you said?
Is value investing dead?
Oh, I
Given
see.
the fact that you have been having all this free money flowing in, coming from the Fed.
I don't think it's dead. I mean, I still see Warren Buffett doing a lot of stuff. And I don't think it's dead. There's a lot of opportunities, but the thing is, the classic definition of value investing, that is dead. So what people who follow Benjamin Graham, people like that, really traditional guys that don't buy stocks over 9 earnings per share or something like that, like that is kind of dead. Like you're not gonna find a company that's trading for 9 times a share that didn't do something wrong. Usually companies that are trading for that low of a multiple is because they're not in a good business. If you find one, you still can. But if you do, you're basically playing a turnaround game. So a good example of that would be Ford, the car company. They were trading at like 7 times earnings or something like that. And they've been trading 7 times earnings for years. So if you would have invested in Ford 5-6 years ago, right now you would still be losing money. Now, for some reason, Ford has gotten their stuff together. They got a new CEO, a guy who actually knows about cars. And now they're starting to do better. So some people would say that paid off. Now, are you willing to accept 6 years of losing money? That is not something most people are willing to accept. So value investing is all about patience. And if you don't have 6 years worth of patience, then it might be dead for you. But if you do, you would do pretty well. Now you have to wait, and you might still be wrong. But in this case, people who waited holding Fords from $5 a share, it just doubled for them. They just made 110% return in 1 year. So maybe it was worth it for them to wait 5 or 6 years. So I don't know if it's dead, but I say that the classical definition of value investing, like buying cheap stocks and hoping they go up, I think that's dead. I think now you have to find a different way to value companies, because companies do so much now. Back in the day, manufacturer would just build one thing, but now manufacturers like Honeywell, they build all kinds of things, and they even have a software firm that does a lot of like software as a service type of things. So even when you invest in something like Honeywell, who used to just make metal, now they're basically a tech company. So it's not the same world; it's a completely different world.
Okay, thank you for that, Scott. And another question, would it be important to consider a concept like sector rotation when it comes to applying the concepts of value investing, especially during a period like this? What sectors would be good to look at for an investor who wants to use the principles of value investing?
Like I said before, you should always invest in the things that you understand. So if you don't understand a bank's balance sheet, then the financial sector might not be for you. If you don't understand manufacturing, then the industrial sector might not be for you. So if you understand tech, like most of us are younger people, and we understand how tech works, like that's something that most of us can invest in with no problem. And we would have an edge over the professionals who are like 100 years old and they don't even understand like what Facebook is. They don't really get it. So it's easy for them to come on TV and say young investors investing in tech are going to get burnt, but that has been wrong for 20 years. So I don't know how they can still hold the credibility. And then at the end of the day, they have to invest in the same stocks that we invest. For example, something that made me laugh was that on CNBC, I think a few older investors came in. They were putting down tech companies. They're like, oh, these companies, this is like a 1999 tech bubble. This is all going to end terrible. That home gamers are going to lose all their money, right? This was like a year ago, 2 years ago. Zoom to today, all those same guys that went on TV talking about how terrible tech was, they own the same exact stocks that retail investors own now. They own Amazon, they own Facebook, they own Google. The same stuff they were putting down 2 years ago, now they can't buy enough of it. Why? Because they don't understand that these companies are not just one thing. Google's not just a search engine. Amazon is not just a retailer. They do 10, 15, 20 different things. And the way of the world, the way that it looks, you guys start businesses, you guys know you have to wear many hats. You have to be the design person, the writer, the speaker, the promoter. Like you have to do so many things. These businesses have to do the same thing. They have to have 10, 15 different revenue streams in order to make it. So if you look at technology like it was in 1999, something like pets.com, which went out of business, they were just selling dog food online. There's nothing crazy or innovative about that. Why did a company like Chewy succeed, which they do the same thing? The reason why they succeeded was because they made it a whole customized experience for people. If you have a pet, they send you like a little card with your pet's picture on it. Like they went above and beyond. Pets.com is just a mail service. So you could tell that wasn't going to work. But nowadays, I say look at the sectors that you identify with the most and stay away from the ones that you don't get. Because especially like financials, because financials are very complicated. And unless you understand banks, it's rough to understand what's going on. Or unless you want to play just the yield curve thing. If you just want to do that, then just buy the banks, because the banks trade basically the same way that the yield curve trades. And that goes to what you were saying about the Federal Reserve, about all the money that's going around. There's so much money in the system that there's really nowhere else for it to go other than stocks. I don't know I don't know where investors are going to put it. Like treasuries are negative basically all over the world. There's just nowhere else to go. So the market might look expensive right now, and it is, but where else is money going to go? It has to go somewhere.
Thank you for that comprehensive response, Scott.
Yeah, thank you.
And finally, this is from me. What is there any sort of screener that one will use to screen out value stocks?
Oh yeah, I believe I put that in my presentation. I didn't talk about that. I don't know if there's any free ones. I'm sure there are, but I've never used them. I think things like Yahoo Finance, things like that, I think they have like basic screeners, but they're not as good as the ones you pay for. And if you really want to be a serious trader and investor, it wouldn't hurt you to invest in something like that. I think the money that you would make from that would be well worth the expense. So if you want to subscribe to S&P Global, that's a good one. They have a really good screener. Um, Basically, every exchange house has one. So S&P, I think Nasdaq has one. NYSE, all the what do you call those credit facilities like Moody's, they all have those. So there's a lot of where you can choose. Also, if you are going to like a university or something like that, sometimes they have access to those things. You just gotta ask them. So you just be like, hey, do you guys have a contract with any kind of like data provider for finance? And they would hook you up. A lot of universities have that. Sometimes if you have a good library, they will have that. Not here in the States, but maybe in your guys' country. Yeah, like I honestly suggest you pay for it because you really want to use a screener that allows you to pick the criteria that you want to focus on. So if you start screening stocks by what it gives you, like let's say it only gives you earnings per share. So you only limit it to that. Now, let's say you want to screen stocks based on growth rate of revenues during the last 10 years. Let's say you want every company that has grown 15% for the last 10 years without missing a single year. You can do that with something like S&P Global. Or you can put like any company trading under, 2 times debt to cash flow. So you can get really precise on what you want. And that would really narrow your results because there's so many stocks out there. If you use one of those free screeners, it's just going to give you a long list of stuff. But if you invest in something like a data provider, you can get a lot more detailed.
Thank you, Scott, for that. Besides, there's no any other question, but guys would like to have access to your presentation.
Yeah, sure.
Yeah. Okay.
All right. I think guys can request us on our email, info@forexstl.com, and then we'll pin you over, or stlsfx@gmail.com. So as we conclude, Scott, and thank you for your time also. As we conclude, maybe besides from Peter Lynch, who you mentioned at the beginning of your presentation, who else could you consider as your trading idol, and what is their bias towards the markets?
Peter was good. He was different because he had such a large portfolio. He had, I think, over 1,000 stocks or something like that. So he had a very good way of explaining things. So that's why I would recommend him. There's a lot of stuff on Warren Buffett, so that's pretty easy to find. Also, Seth Klarman, I believe his name is. He's good. He wrote a book on marginal safety. I think I posted the picture on my presentation. That's his book, Seth Klarman's book. So if you want to understand everything about marginal safety, that's the guy to talk to, or the book to read. And there's a lot of videos on YouTube of interviews with value investors. So if you guys go on YouTube and just type in value investor interviews, you will see a lot of stuff, and you would actually learn a lot from just that. And yeah.
All right. And how about the books you recommend on value investing? And then as you conclude, maybe you can tell us, because I know you normally have a blog where you post stuff about value investing. Maybe you can mention that for guys to have a go to your work as well.
Yes. I don't remember the URL, but I'll send it to you, and maybe you can post it on your website somewhere. And The books, I think it's the Peter Lynch book that I've mentioned before, Beating the Street. It's one of them. What was another one? There's so many of them I can't remember. Oh, I just said Margin of Safety by Seth Klarman. What's another one? To be honest, Stocks for the Long Run. I forgot who wrote that, but that's a pretty famous book. And yeah, those three are good.
All right, maybe you can email me the names and the publishers for that, and then we'll pin that on the show notes. And guys, if you want to access this entire presentation, we normally upload it on our YouTube channel a week from, so it will be up next Friday. So thank you, Scott, for your time. We loved your presentation. I think we've learned a lot, and it's glad to have you. We'd love to have you again in the future if your time allows. For now, it's a goodbye.
Yeah, thank you very much for inviting me, and hope everything goes well for you guys.
All right. Cheers. Bye.
Bye.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.